Today I'm joined by Alma and Ross to talk about year-end tax planning considerations for Americans living in the UK. So Ross, what's the number one consideration for Americans over here in the UK?
Paying enough UK tax before the 1st of January to ensure they have sufficient foreign tax credits on the corresponding US return.
And how do they do that?
Well, they can physically make a payment to HMRC and ensure that it's in the calendar year that the income item or gain has occurred, and they should be able to claim a credit on the US return.
How do they work out how much to pay?
It's really by talking to your tax advisor and having an estimate of the UK taxes due if you don't know the full amounts that are owed.
What's the major components of the estimate?
We're looking at income streams whereby there's no withholding at source, significant one-off realisation events during the year, capital gains, carried interest.
So what sort of events? Does that include selling your house, things like that?
Selling your house, selling shares, any real significant taxable assets,
Anything without tax withholding, really. I think.
Individuals that are transitioning from employee to partner, or already partners, already self-employed, have not had withholding taxes at source.
So major changes in your circumstances. They really do require you to do some planning at the end of the year.
Yes.
So how do you actually make that payment? What do you do?
You can pay online or write a cheque at times if you don't have online means of payment. But the key thing with that is making sure that you have a UTR, which is a unique tax reference. Otherwise, any payment to HMRC is just going to be sitting somewhere and it's going to be quite hard to allocate to you. So, those kind of things, because UTRs can take so long as well, you want to have that conversation and make the application ASAP, really. And
for international taxpayers, what's the main consideration about how you make the payment? Where do the funds come from?
That depends on how you file in the UK, whether it's the rising basis, i.e. subject to UK tax on worldwide income and gains, or on the remittance basis. If you're on the rising basis, it's likely that it'll be preferential for you to make your UK tax payment from overseas monies, thus preserving your UK liquidity.
So if you've been subject to US withholding, is that sufficient? Do you need to think about year-end planning?
Absolutely. There'll still be a number of income streams, no doubt, whereby there's no withholding at source, whereby the UK has the primary taxing right on that income, and so therefore you will owe UK tax to HMRC, and that should be paid before the 1st of January, so you've got the credit on the 2022 US return.
So what happens if you get your year-end payment wrong?
Potentially double tax. If you don't pay enough UK tax before 1st of January 2023, then you could be in a double tax situation, and that's obviously a cash flow burden as well.
And what can you do about that?
Well, as Ross said, it's a potential double tax issue, but the way to fix that is by making the payment maybe in the following year and having to make a carryback claim to get a refund for the overpayment or double taxes that you have
So you can carry back foreign tax credits to previous years?
You can carry back 1 year, and that carryback is really to fix this potential double tax issue that you've had. It aligns to your cash flow. But the issue with that is you have to wait until you've submitted your next year's tax return before you even make that carryback claim, which can be an 18-month plus wait, and you're subject to the IRS's mercy, really.
So that's a really tight turnaround time. So you need to make this payment and get it right at the end of the year. And if you don't, you could be double taxed. You could be paying the IRS tax and HMRC tax on the same income.
Yeah, definitely.
So if you make your year-end payment, will you owe any US tax in April?
Almost certainly, particularly if you've got US source dividend income, there'll be at least 15% owing to the IRS on that. If you have significant investment income and gains, interest, dividends, rents, royalties, gains, you'll be within the realms of the 3.8% net investment income tax, cannot be offset by foreign tax credits, so that will definitely be in play. Other income streams, US source real estate, US source partnership income as well. The US has the primary taxing right on that, so yes, you would still owe to the IRS in that situation.
So it sounds like it's vitally important Americans get their year-end payment correct.
Absolutely, it's imperative that you're liaising with your US-UK tax professional, and particularly if, for example, you have an advisor looking after the US side and a separate advisor looking after the UK, make sure those two parties are talking to one another at this time of year.
So outside of foreign tax credits and year-end payments, what other deductions are available?
So we have something called itemized deductions in the US, or as some people call it, Schedule A deductions. This can be charitable contributions, mortgage interest payments, state taxes paid throughout the year, investment expenses, even medical expenses if you meet the required limitations. I think for the medical it's 7.5% of your AGI. But in total you don't really tend to see the use of Schedule A deductions that much anymore, considering the Trump Reform Act, where the standard deduction went up so significantly that you have to really be making large payments to charitable or your mortgage interest to really get the benefit of the Schedule A deduction.
So what is the standard deduction for 2022?
It's $12,950 per person, and double that if you're filing as a joint couple. So you really have to be making contributions or mortgage interest payments, state taxes well above that to get the benefit of going down the itemised deduction route. And with all the tax changes that have gone on over the years, for example, state taxes, it used to be limited to your AGI, but now it's limited to $10,000. So you might be in a a high tax state like California or New York, and be paying way over $10,000 a year and still not get the benefit of going down the itemised deduction route.
So are we seeing less and less taxpayers use the itemised deductions?
I think so, absolutely. Especially you've also got another big expense that used to be claimed on itemised deductions was a 2% miscellaneous deductions. That was in like investment expenses related to like brokerage accounts and those kind of things. But without that deduction allowed anymore for personal investments, it has to be large charitable donations really, or a significant mortgage interest payment that's really going to get you down the itemised deduction route. And even with mortgage interest, that's also limited now to the value of your home, depending on if you're filing jointly or if you took out a mortgage before 2017 or if you've refinanced. These can all affect things that would allow you to claim the itemised deduction. So yeah, it's really standard deduction for most people unless you're actively making a choice to make a donation to charity.
So how do you get a deduction for charitable donations that you make?
It depends how you make the donation. If you're making a cash donation, it's limited to 60% of your AGI in the year. So this is why I'm saying that you might want to consider the timing of the donation at year-end planning time. For example, if you've got a high income year, like you've had a big bonus, you've had like large sales of stock or something like that, that would be a great time to make a donation to charity because your 6% of AGI is going to be huge. If you're retiring the following year and your income's going to drop significantly, you might want to think about going down the standard deduction route, or at least flip-flopping each year or something, whatever suits your situation.
So how do you get a deduction for donations you make to charity?
Well, it has to be to a qualifying charity, something that is registered with the IRS if you're talking about US taxes. If you're talking about UK taxes as well, it has to be something that is approved by the Charity Commission. But the good thing about US, UK individuals donating to charity is sometimes you can get double deductions, one in the US and one in the UK, and that's what we call dual qualifying charities. They've got exempt status in both countries, and you can therefore take a deduction in the US and the UK the following tax year or the year that you make the donation and get a benefit. The key thing to watch out about that though, and why it's always great to talk to your tax advisor, is if you're making a significantly large donation to a dual qualifying charity, you might not have, you might have contributed so much that your tax rate is actually quite low in the UK, because as the UK system works, it increases the amount of tax that is subject to 20%. So I've seen situations where people can get stung by this foreign tax credit issue that we were previously talking about, where your tax rate is actually quite low and you don't think you need to make a payment in year-end planning time, and actually you've got a payment to make.
So you can end up owing tax because you've given too much to charity?
Yeah, absolutely. Or the wrong spouse has given to charity. Like, a lot of couples tend to just write a check out because maybe it's a joint bank account or something like that. But if one spouse isn't working and the contribution is in the other spouse's name, you might not actually have the correct deduction in the UK, which can affect the US taxes.
And important to note, it's not just cash that you can gift as well. Non-cash, i.e. shares, you can gift and be dual qualifying as well across both sides of the pond. If it is non-cash, i.e. shares, then it's from a US point of view, it's up to the limit is 30% of your AGI, not 60%. So just be mindful of that.
So what's the benefit of giving shares rather than cash?
The benefit of giving shares rather than cash is you can also save on the capital gains tax, the appreciation of that stock. So you've got a double whammy really there. So you're saving on the capital gains tax and you're getting tax relief via the gift of those shares. So yeah, it's good.
That's a big one that we should really be talking to clients like well ahead of the year end, because also like arranging for the sale of the donation of shares can be quite a lengthy process.
Yes.
But the benefits are huge.
Yes, absolutely.
So it's not just as simple then as making a donation on Just Giving. You actually have to think about this and put some planning in place to maximise your tax deductions on both sides.
Yeah.
Also DAFs as well, donor advised funds, which are quite helpful, because I was talking about earlier where you have this high income year, but you might not know what charity you want to donate to yet. But the deduction point for a DAF is when you make that contribution to the DAF, not when it's given to the charity. So that's a really effective planning tool to make sure you're going above that standard deduction limit of 12,950 and utilising your donation as best as possible, really.
Yep.
Sounds like a really useful tool to control your donations and maximise your tax deductions. Should Americans consider gifting to friends and family before the end of the year?
Yeah, so I personally think it's really underused from US taxpayers, is just making gifts to family and friends, making use of those annual allowances, $16,000 per recipient in 2022. If you want to gift it jointly with your wife, you can double up on that, so it's $32,000 per recipient. Downside to that, however, is you then have to file a gift tax return, a Form 709, where each spouse does, with the consenting spouse signing one another's return, so you have the compliance fee with that. If you are gifting to a non-US citizen spouse, so this is not just non-US persons, but this is also green card holders too, because they aren't citizens, the limit there is $164,000. That's increasing to $175,000 from 2023. And the overall lifetime gift and estate tax allowance in the US is huge, 12.06 million in 2022, going up to 12.92 million in 2023. So that, as a married couple, that's $25.84 million that you can shield from US gift and estate taxes.
Excellent. So what are the benefits of gifting? What does that do to you? What help does that give you at the end of the year?
You're moving money outside of your estate, essentially. To the extent that assets and monies are within your estate when you die, you're looking at 40% estate tax in the US, to the extent that those aforementioned allowances have been breached. Important to note, the lifetime US gift and estate tax allowance going up to 25.84 as a joint couple, or 12.92 individually. That is due to sunset at the end of 2025, i.e. it will effectively halve to around 6.5 from the beginning of 2026. It's on a use it or lose it basis. So if you're in a fortunate enough position to gift more than 6-7 mil, you want to be doing that before the end of 2025.
So every dollar that you're gifting is essentially saving you 40% of tax in the future.
Yes.
But you have to also think about how you're gifting that money. For example, a lot of US people, because the lifetime exemption is so huge, sometimes just think they can set up a trust and gift to a trust and there's not going to be any consequences. But if you're in the UK, the US trust is sometimes not really compatible with UK taxes. So whereas a trust might be so common in the US to use up that 12 point something mil.
12.92.
There we go.
Yeah.
The 12.92. You should really have conversations and see if it's suitable for UK purposes as well.
So I assume because the threshold is so high, the 12 million that they get, gifting hasn't really been thought about by many Americans in the UK. But if that's going to half, do we expect to see much more gifting by Americans over here?
Yeah, but before 2026, absolutely. If you are in a fortunate enough position to do so and gift more than what it will sunset to, which is expected to be around half of that, so call it 6.5 million.
But the good thing is, even when it does sunset, if they don't make any provisions to keep it on, you still got the 16k per person.
Yeah.
You still got in the UK equivalent of potentially exempt transfers, gifts out of excess income.
Yes.
So that can still help chip away your estate, but that 12 point something mil is quite huge.
It is huge. Now, obviously the US has got that. The UK has got a piddly nil rate band in comparison of 325,000. But as Alma's alluded to, they do have this concept of a potentially exempt transfer, i.e. if you survive at least 7 years from the date of the gift, we don't care, it's outside of your estate. That's just not considered anymore. And that's for individuals who are domiciled in the UK.
So slightly more straightforward if it's Americans gifting to Americans, but Americans gifting to non-American spouses subject to UK tax, it becomes slightly more complicated.
Yes.
So what other considerations should clients think about at year end?
Quite a few clients will probably find themselves in a position where year to date they've got significant capital gains that they've realised. They may wish to check in with their wealth manager, if they have one, to analyse their portfolio to see if they've got any unrealised losses that they may well wish to realise before 1st of January to help bring down that net gain position. The losses will offset the gains, not other income, unless the losses are more than the gains, in which case you can have $3,000 offset in other income if you file jointly, $1,500 if you don't file jointly. But it's typical planning at this time of year to harvest some unrealised losses.
So in theory, any loss that you realise could reduce your capital gains tax liability?
Yes, absolutely. And capital gains tax liability being 23.8% if they're long-term gains, i.e. held for at least 12 months, or up to 40.8% if they're short-term gains, i.e. held less than 12 months. Unless, of course, we're dipping into the world of carried interest, where they have to be held for at least 36 months in order to be treated as long-term gains.
Okay. And so away from the economy, what about the interest rates?
Yeah, so the surge in interest rates has meant that some individuals may be considering refinancing their mortgage. Now, what you have to be mindful of from a US tax perspective is that there is this concept of phantom foreign mortgage gains, and with the pound weakening so much against the dollar in recent times, it could be that you actually do realise a phantom foreign mortgage gain upon the refinancing or upon paying off some of the capital on your mortgage. For example, if you took out a mortgage for, let's keep the number simple, $100,000 when the rate was £100,000 when the rate was 1.5, that's 150k USD, and then you refinance it or repay it when the rate's 1.1, that's 110,000 USD. In the eyes of the IRS, you've got a phantom foreign mortgage gain of $40,000, and absent some careful planning with a competent US-UK tax professional, you can find yourself owing tax at up to 40.8% on that, because it's treated as ordinary income, and the default position is it's subject to 3.8% net investment income tax as well.
So even if you borrow the same amount of GBP, you could have this gain?
Yes, absolutely, because you've got to look at the FX and what that is in US dollar terms for US tax purposes.
What's annoying though is that you can't take the loss.
You can't.
So
no.
you've got they're ready to tax the gain, but that loss is not claimable, unlike the harvest losses that you were talking about earlier.
Yes, yeah. And that's because these losses are deemed personal. And they're typically in relation to a personal property. So,
is there a particular set of individuals that find this period challenging?
Yes, partners. So if you're a partner in a professional partnership, or perhaps you're an investment manager, and you're a partner of an LLP, and you've got your trading profits, plus you may well have carried interest, this time of year can indeed be challenging, and you need to ensure that you're really on top of your affairs and liaising with your US-UK tax professional to make sure you're paying enough UK taxes ahead of 1st of January, because, for example, you might have a spike in your profit allocation. Those profits, those UK source profits, go to typically the foreign branch basket. You might not have enough foreign tax credits in that basket carrying forward from the prior year and from what you paid UK tax-wise to date, i.e. your July payment on account. You might want to make sure that you're paying a top-up, an advance to HMRC before 1st of January. Equally, if you're in the realms of carried interest and you've got a distribution that's just been paid out, or is going to be paid out between now and 1st of January, you need to be making sure that your tax professional is fully au fait with what that carried interest comprises of. Is it gains, interest, dividends, trading profits? How are you filing in the UK, a rising basis, remittance basis? Have you got enough foreign tax credits brought forward from the earlier years? Quite a lot to think about, but more than likely you will need to make a UK tax payment before 1st of January.
And it's important to really have those discussions with your tax advisor throughout the year, especially because the UK fiscal year is different at year end to the US year. So the information needed for these kind of estimates might not be available until November, December for UK taxes, which leaves quite a small window to get everything done. But if you know you had a big carry distribution, or you're about to have a big carry distribution, even just being aware of that now and having that discussion can really help.
Yep.
So if you can make one recommendation to US Americans living in the UK now, what would it be?
Talk to your tax advisor and keep track of the money you receive. even just not only for year-end planning, but for US tax estimates if you need, like just so you were saying that you might have estimated taxes throughout the year for net investment income tax and that kind of stuff. If you have these constant conversations throughout the year, nothing will be a surprise, or hopefully nothing should be a surprise. Yeah. And then when it comes to April and you're doing your extension, if you do need to make an extension, you already know what your tax liability is going to be. So yeah, talk to your tax advisor.
Yeah.
What's your one key takeaway for our clients, Ross?
One key takeaway, I think the biggest ticket has to be foreign taxes. Making sure you've paid enough before the 1st of January to ensure you have sufficient foreign tax credits for the current year, i.e. 2022, and to the extent you've had a shortfall in the prior year, that you've got enough to carry back so you don't lose that potential refund. Because you can only carry back foreign tax credits 1 year. They can be carried forward up to 10 years, but they can only go back 1 year, so it's critical that you get it right. And if necessary, be prudent, be conservative, and top it up a little bit, cash flow permitting.
So a lot to think about, but that's what we're here to do, right? Here to help.
Indeed.
Yeah.